I think there is a lot of uncertainty out there, and that's probably one of the things that's holding back in investment. The thesis of the tax cuts was there would be more investment, and the last quarter or so, it's kind of gone in the opposite direction, and I find that concerning. On the trade front, I think President Trump believes that he's got a winning hand, that this trade war is hurting the Chinese economy more than it's hurting the U.S. economy. But arguably now, maybe we're starting to see a little bit more signature in U.S. performance with the recent softening of investment. And frankly, I think the trade war is at least partially responsible for this volatility that we're seeing in equity markets. As Steve pointed out earlier, Wall Street doesn't like this trade war. Whether or not it gets to a better equilibrium on down the road is very much an open issue. But what we know is it's creating uncertainty and some pain now.
I think the question that becomes is, does that affect CapEx spending? Because we've been looking for big CapEx spending because of the tax cuts. Does uncertainty related to trade affect the end result?
Well, as was suggested, I mean, we've seen in Q3 investment soften. These capital goods data are not all that great. We got to kind of step back and say, well, why is that? And one explanation is the month-to-month data, quarter-to-quarter data are noisy. And maybe we are on a rising trend. But another explanation is maybe there's some concern out there in the economy, in the corporate sector. It could be these firms are constrained by the leverage that they're holding. It's also possible that they're constrained by uncertainties about where economic policy is headed, particularly trade wars.
I think the jury's still out. That's been the story in the Beige Book. If you read what the Fed's Beige Book says, it says that companies are uncertain and holding back investment because of tariffs. I do want to make one other point, which is an unknowable thing: how much the decline in oil prices has hurt business investment. You know, to take a little bit away from the administration's theory of the case the last year, a lot of the boom we had, a lot of the change from Obama was a low oil price at the end of his term and a higher oil price that came in with the president. Some portion of this that we need to disaggregate is from higher oil prices, and now maybe some of the fall off is from lower oil prices. We need to look at an X energy, and I just can't do that on the fly.
What you're saying is staring us in the face. 10 out of 10 analysts that we have on, and we have on a lot every week, stock market, you know, soothsayers and pundits, every one of them says tariffs. That's always the number. It's either Fed and tariffs, 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 Fed. Every single one of them. So I mean, it just seems obvious that I mean, CEOs watch this show, and they're no different than a lot of the people trying to figure out the market.
But you used a word that always scares me, which is you said you think that some of these companies might be worried about their leverage levels.
Yes. Okay. Yes. Oh, absolutely.
But speak to that, because we have not had that conversation.
Absolutely. When you look at corporate America, there are more firms in that BBB credit rating than was the case before. And when you're sitting there at BBB, and if you're at all worried about any kind of adverse shock, including maybe a recession on down the road.
How about rates going up?
Or rates rising? Yeah, absolutely. Then you start thinking about credit migration.
That's the Fed side of it.
And then you got to think about, well, what is life going to be like in the high yield bracket? And, you know, maybe folks are pulling back a little bit on investment.
Yeah, but a little bit is different. I mean, it's hard to imagine that there are companies, I mean, I know there are some out there, but that the vast bulk of companies don't have pretty good credit profiles in the sense that they've had a long time to both term out their debt and negotiate down into lower interest rates. I think that compared to previous credit cycles, if we do have a decline this time around, it's got to be a lot shallower and easier than previous ones.
So I think there's an analogy with the corporates and the households. When we look at aggregate data, it looks good.
Right.
And they have termed out exactly as you said, and aggregate debt service levels look pretty good. But within the household sector and within the corporate sector, there are pockets of problems. And I think
That's right.
It behooves us to pay attention to these BBBs and what might happen if we had a shock associated with the trade war. Yeah.